Okay, there we go. So good morning, everyone, and welcome to our Sentio portfolio pulse session. This is the one for September, and I hope that wherever you are logging in from, the weather is actually quite good. We're still experiencing the last little bit snap of winter. So yeah, thank you for taking the time. Our sessions today, we're actually using a bit of a new format. It's in a webinar format. To see how that goes. If you have any questions, please just put it into the Q&A section and then we'll answer it as we go along. So as per normal, we've got Imtiaz Suliman, who's our head of the Shariah Solutions. He's going to give us a bit of a macro overview and then talk about a share. And then I'm going to wrap it up a bit with a little bit of what we shared at Meet the Managers this year in terms of the optimal portfolio mix. So I'm not going to share all of it in one go. What we're going to do is we're going to break it up into pieces and I'm just going to fill the gaps in. But we'll share enough so that it's interesting for you to see actually how we go about putting together portfolios and blending the assets. So as per normal, people sort of tend to log in 1 or 2 minutes late. So we're going to give it another minute or so. And then Imtiaz is going to start his presentation. So I hope that you find value in the session. As per always, guys, we do get 0.5. I know it's not a lot. Technical CPD points for this half an hour. And we generally send it out. All the certificates for August sessions have been sent out already to those that attended. So in future, always remember there is a bit of a value add for you as well. So we're going to give it a minute and then Imtiaz is going to go and take us into the session. Thanks.
Good morning. Thank you for joining us today. Thanks, Verlyn, for that introduction. I think we'll kick it off and jump straight into the presentation. We've got a two-part presentation for you, as usual. I'll talk a bit about the markets, focusing on a stock, and then Verlyn will come in at the end talking at some of the styles and factors and the way we look at portfolios. So looking forward to the discussion today. I thought it's apt to start off with this quote. The function of economic forecasting is to make astrology look respectable. And that's by John Kenneth Galbraith. And it's very opportune at this moment in time where there's so much forecasting and so much emphasis being put on what the Fed is going to do with regards to interest rates. We know interest rates are going to come down. But now the discussion has really moved towards, is it going to be a 25 basis points cut or a 50 basis points cut? And when the market puts a lot of emphasis on, essentially one economic data point, it brings in a lot of volatility. And we'll see in some of the upcoming slides how this volatility has manifested itself in the market. Just starting off with an overall market performance review for the month of August and year to date. What you can see there is financials were again a standout performer for the month of August, up 5.6%, which brings its year to date return at just under 21%. Industrials, second best performer, and for the year to date up 11.8%. Bonds have given you 2.3% for the month and 12.3% for the year to date. From an overall all share perspective, the market is up 11.4%. It's been a decent start to the year in terms of market performance, despite some of the global challenges, although locally the economic scenario is looking much more upbeat. And then cash, just under 5.7%. And the one sector that's really been struggling is resources. And we'll talk a bit about why that is the case. So if you look at some of these macro factors, and again, to reiterate, it's been a similar theme for the last year in terms of the macroeconomic factors that have really been driving the market, and essentially what's been driving the policy that we expect out of central banks. So to start off with, inflation, and I think the discussion now globally has moved from inflation towards growth. So inflation has come down quite considerably. We've seen the US inflation, peak year on year at over 9%. The latest number that came out yesterday was at 2.5% on a year-on-year basis. So clearly inflation is trending downwards and has come down quite significantly, but the market focus now has moved towards the unemployment levels and what's happening in the jobs data. There's certainly a theme of weakness coming through in the jobs data, but it's not falling off a cliff. And this is what's driving markets. If we do have jobs data weaken significantly, then it would seem to be that we're entering into a hard landing scenario from a macroeconomic perspective. But that's not been the case. There was some volatility with regards to the jobs data and jobs data being revised downwards. But nonetheless, it's a very robust jobs scenario in the US especially, and that should bode well for consumer spending, as 70% of the US economy is driven by consumer spending. Global growth is also been on a downward path, and we've seen that impacted a lot by what's happening out of China. And I think China is the focus because although they've set their policy target to grow their GDP by at least 5%, we've seen weakness come through, especially in the property sector. And that ties into the sector performance that I showed in the previous slide. Resources have been under quite significant pressure, and a lot of that weakness is being driven by the weakness that we're seeing out of China, but in particular out of the property sector in China. China's property sector has been in a downward spiral for over 18 months now, although other parts of the economy are doing pretty well. And that's what China is focusing on now. They're shifting the economy and trying to rebalance the economy to be less reliant on property. Whereas property makes up 30% of GDP, they've pretty much exhausted a lot of what they can do from a property perspective. And to avoid a property bubble, they need to rebalance the economy and get the services side of the economy start to carry more of the weight. This is a new feature to the Pulse session, and it's a chart of interest. And what you can see there is the VIX index. Essentially, the VIX index is the volatility index of the US markets. And this is often referred to as a fear gauge. So when you do see the VIX index spike, there's a lot of fear in the market. And that certainly happened at the beginning of August, where you saw a massive spike in the volatility. And this was caused by two factors. The first factor was the US jobs data, which was weaker than the market expected. And that brought about a lot of concern that we're entering into a hard landing scenario whereby the Fed would need to cut rates aggressively, but it might be too late because the jobs data was weakening quite significantly. The second driver for this huge spike in volatility was the Bank of Japan raising interest rates by 0.15% to bringing that rate to 0.25%. And whilst that is still an overall low interest rate, it did bring about concerns of Japanese savers essentially repatriating money from around the world. So the yen carry trade has been quite a significant provider of liquidity around the world, whereas Japanese investors essentially borrow in yen, invest in high yielding currencies, invest in US tech stocks, and that's been driving a lot of the carry trade that we've seen. And because the interest rates went up in Japan, that brought about concerns that investors will bring back money back to Japan as interest rates start to look more attractive. Focusing on, one of the stock in the portfolio and a stock that's been quite a positive contributor and alpha value adding position to the portfolio is Bidvest. Bidvest is essentially a diversified South African company. They play in multiple spheres, touching all of the industrial points, whether it be the freight side, the industrial goods side, the services side, the motor-related side. Bidvest has segments in all of those divisions. So it's a geared play on South African GDP. If the South African GDP does get better, Bidvest is well placed to benefit from any upswing that we will see in improved GDP. We've seen that they've got a very good, highly rated management team in place. They generate a lot of cash, and their returns on those cash are very attractive. So Bidvest has been part of the portfolio for a number of years, although the weighting scheme has been adjusted from time to time as we've seen the share price get closer to its full fair value. But we still see decent upside in Bidvest with a target price of 340 Rand, which is essentially 19% upside from current levels. Delving into some of the drivers of Bidvest, as I mentioned, they a very diversified industrial play. The biggest driver from a revenue perspective, as you can see on the left-hand side, is services, which makes up 40% of the revenue and also 40% of its trading profit. So essentially, services are made up of two parts. The one is services in South Africa, and the other is services internationally. And there, they play in the airport handling services. They play in office cleaning services. So they're really quite diversified from that perspective. But also, what's quite attractive is very annuity type in nature, which means that when economic times do get difficult, those contracts have quite a long lease in place, and that leads to more stability in its overall income. From a automotive perspective, just to highlight, automotives made up 19% of revenue, but only 6% of profits. And this was really due to the automotive division coming under pressure. As we know, inflation has been quite high in South Africa. Interest rates has been quite high. And as a result, motor vehicle sales haven't been as robust in the last year as we saw them, accelerating post the COVID boom. From a commercial perspective, again, they play in the renewable side. They play in some of the tools DIY. So again, very much geared towards a recovery in the South African side. From their latest results, what you can see there is trading profit was up 8.5%. And this is on an overall basis. If you look at it on an organic basis, trading profit was up 5.6%. And the difference there is really the acquisitions that Bidvest makes. They're a very good allocator of capital, looking for opportunistic targets. And that has, bode very well for them in the past. They've made some good acquisitions. Usually when a company is very acquisitive, it does raise some red flags for us but Bidvest has a long history of making very accretive acquisitions that are rather bolt-on in nature rather than transformative. And they add to their platform, increasing the scale and increasing the value add that they can bring to the end client. They deliver excellent returns. Their return on funds employed essentially is 37%. Their return on invested capital is at 16%. And this is really world-class returns. So very good cash flow generation, excellent allocators of capital, and we think they well positioned to benefit from any uptick in the South African economy. So we still hold Bidvest. It's one of the top holdings in the fund. There's still decent value in the counter, and we will continue to hold it, until it reaches fair value. So with that, I'm going to hand over to Verlyn for his section. And if there are any questions, please put them in the Q&A and we'll answer them at the end of the presentation. Thank you.
Okay, cool. Thanks, Imti. Let me just share my part of this presentation and then get going. Okay, so Imti has now given us a very nice breakdown and in-depth in terms of the market and the share that actually contributed quite well. So what I would like to talk about is this is the theme that we talked about at Meet the Managers, and that was investing with style. So the whole idea of investing with style is basically to give you more time in the market instead of trying to time the market. So what that actually just comes down to is just blending different styles of investment. So you've got growth, you've got value, you've got momentum. Growth and momentum sort of go together. Then you've got value, and then you've got quality. Now, obviously, in different business cycles, these specific styles actually work slightly differently. So you don't want to be in one style all the time. So you will see we talk about an optimal portfolio, and that comes down to the blending of the specific styles that we use at any point of time. So if you just look at the world, and it's great that Imti included that VIX index, but if you look at all of these updates, I mean, there is so much uncertainty in the world. We're now going into a US election that just confuses everyone what's happening there in the United States. The Ukrainian war is still raging. The Middle East conflict is still going hammer and tongs, and we don't hear about it. So it's very difficult. So you need to position yourself in a way where you take opportune positions to make use of this volatility. Volatility is not a bad thing. You just don't need to be on the wrong side of it. So how do we go about just making sure that we're sort of positioned to take the best of it? So if you're feeling overwhelmed as an investor and you have to go make these decisions by yourselves, we don't blame you. If we had a crystal ball, we wouldn't be having this session, because we would all be investing in the next Bitcoin. Honestly, I still think every time I hear what the Bitcoin price is, I remember in 2017, I thought, Bitcoin is not going to last. So I didn't have a crystal ball. I made a mistake. But what can you do? So the best thing is to just rely on fundamentals that you can control at the end of the day. So what does that mean? It means that you go back to the asset classes. So what do you need? You basically then go and need an investment solution that works throughout all of the market cycles. It maximizes opportunities by actually weighting the portfolio into different styles, and then minimizes the downside risk. And the reason why you want to minimize the downside risk, quite simply, is because people want to stay invested. If you have a lot of volatility on the downside, that's difficult for an investor to stomach, and you want that investor to stick because you've identified a goal at the end, and obviously then you've proposed the solution, and as a financial planner, you need to give that solution time to work through all of the market cycles. And from our side, we do that through blending from a multi-asset portfolio it in a specific way. Now, What is style or factor investing? So it's the same thing. So if someone talks about factor investing, they're actually just talking about the style that they employ. What is it? So basically, and this is Ray's analogy of thinking about it. So food and equities, same thing. Think of it in the same way. So when you eat food, you consume the nutrients, and those nutrients keep you alive. Same as if we go and look specifically just at equities in this example, we're not talking about fixed income or anything like that this day. Um, you make money through risk premia. So you take on risk and then you earn a return based on that risk that you've taken on. And in terms of the nutrients are proteins, carbs, fats, and vitamins. And then for our purpose, for this discussion, we take on the risk premium or we generate the risk premium by taking a position in a specific style. So that be it value, growth, and quality. So you'll see momentum's not included there, but growth momentum's the same thing. So we've just broken it down to 3 to make it understandable and to show you a little bit of what happens in the market. So what are the important styles? So basically, we've got the 3: value, growth, and quality. So value tends to be more cyclical, and it's tend to look at companies that are out of flavor. So what that means, out of flavor, is a company that's not very popular. And because that company is not very popular, it tends to trade at low multiples. And that would be a value company. So you'd identify it like that. A growth company on the other side, completely different. It's innovative. They've got faster growth. They tend to be a bit younger, so they would probably not be paying dividends and things like that. And they would be trading at higher multiples, quite simply because the market and the market participants are valuing this company based on its earnings and its potentials and things like that. So you can see it's completely different from a value type of company in terms of its metrics. And then quality, you've basically got a strong moat, which means they're established. They've got a competitive advantage that's difficult to sort of for outside companies to come in and chip in. Quality companies are consistent, which means they've established infrastructure spending has been done, earning consistent streams of income. Generally average multiples, but nonetheless, when things go pear-shaped, you want to be where the cash flow is, and a quality company would probably be paying a dividend as opposed to a growth company. So this is just a highlight to see practical terms how the styles actually differ that we employ. So it's not just a mix and match. Certain things happen. So when does value make money? When you've got multiple expansion, that means your earnings multiples. And when you have got growth that exceeds expectations, remember it's an out of flavor company. They all of a sudden come and start producing. That's when you're in. So you're in quite early when it's out of flavor. That's how you make money. Warren Buffett style. Growth companies, making company, how do you make money here? High multiples. How do you make money? Market underestimates the growth potential. So it's got growth. People think it's going to work, but potentially they still underestimate the growth potential of this company, and it keeps on growing and it becomes a market leader. Remember, a growth company is not always established, so you don't know whether they're going to last. But if they stick around and in the long run start earning sustainable income, you could be doing quite well. And then quality, obviously, there is you just sort of cut out the companies that are bad. And that's something that you can control. You don't always have to be right, but just make sure that you're not making like serious errors on the downside. And that's something that we can control. So using style factors to identify opportunities, value, growth, and quality again. So this is an example of the different styles. So a company such as Nedbank would be a value company. Companies such as Growth, Shoprite, okay, they've been around for quite a while. And then quality, Imti did quite a substantial analysis of Bidcore and why that's a quality company. But yeah, those were the 3 examples of companies that would fit into the different styles. So you would see depending, and this is one major important thing. Not all companies remain in that specific style. If the underlying metrics of the companies change, they sort of can move around between growth and quality and value and things like that, depending on what is happening in the company. So obviously, every style has its day in the sun. So it's not always sunshine and roses for every style. So let's quickly show you a little bit of a table. So what you would see here is we've gone back about 19 years or 20 years. And then you can actually just look at the metrics here and the returns that were generated by the specific styles. So the Aussie on the right-hand side, in that specific year, returned 47.3%. That was a really good year, depending on whatever style you went into. And then 2008, obviously, that was the global crisis. Not very good, regardless of what you did. But you will see quality actually versus growth relative, you will see that quality outperformed. So obviously in that year, if you hold quality, you would have been okay. But you can't time this, or you can't expect this. This actually just gobsmacked anyone. 2020 again, somehow this again here, I think value did quite well, because I think people maybe underestimated a lot of low companies and maybe went into value, low PE multiples. But yeah, quality actually struggled in 2020, believe it or not, but came back strongly again the year after that. And then you will see in 2024, value at minus 3.4, growth at 5.1, and then quality at minus 3.9, and the Aussie at 0.6. So, guys, I'm not here to justify any specific style, say value, growth, quality. The point of this table is just to show you that depending on what happens in the marketplace, a specific style outperforms and a specific style underperforms. And as an active manager, Sentio has a process in place where we identify probabilities of styles that would do better in a specific market cycle. And that's what we do. We're not forecasting, but you work on probabilities looking at what is happening in the marketplace around you. Now, you as an investor, you don't have the time to do that. That's why you would employ an active manager. And the purpose of this graph is just to show you that you need to be in specific places at specific points in times to take the most advantage of the market. So growth across that whole table, believe it or not, was actually the most consistent style. But let's quickly look at this. So we would see, and this is how we spent it. We actually broke it down, time spent at the top and time spent at the bottom. From that whole table, quality, you would see it's sort of 50-50. It spends as much time at the top as it does at the bottom. And from our context, growth actually spends 40% of the time at the top and 20% at the bottom. And then you will see value spends about 30% of the time at the top, but relative to its own performance, spends actually more time at the bottom. And then Aussie as an index spends 15% of the time at the bottom and 10% of the time at the top. So it's not always the one style always at the top, and it's not the one style always at the bottom. So you sort of have to blend this. So growth in our specific context here has been a bit the most consistent in terms of being a top performer, and then the least consistent, because it's always been at the bottom the most relative to its own performance, is value. But obviously you need to be in the market at the right time, because when value outperforms, you need to take advantage of that very sharp outperformance. So you must not miss that value spike. So yes, this is actually a bit confusing. It does spend a lot of time at the bottom, but value when it spikes does really well. So you need to be in the market there, and therefore you have a bit of a blend of an optimal portfolio. So that's it from me for today in terms of our process. The next time around, I'll delve a bit deeper into this discussion. So we'll continue the discussion. It's actually very interesting how we blend it and what we have found to be the optimal blend of asset classes. So this is just our platform availability, guys. We are busy working on getting our portfolios available across all the major platforms. If you have a specific query or question, or you are a larger supporter and you want this portfolio to be on a specific platform, let us know and we'll engage with the platform. But this is an ongoing job, but you will see we are busy working on it. And that's it from me. Let me stop sharing. So I would like to just take the time, Imti. I don't know if you saw any questions.
No, not at the moment.
Okay. So guys, thank you very much for taking the time to actually be with us this morning. These sessions are actually becoming quite popular. We've been getting feedback where people say they are actually really appreciating the effort that goes into it. Thank you, Imti, because he does take time out to prepare for this. And thank you, everyone. There's a lot of things going on. I know Inate's got a large thing going on this morning. So thank you to everyone. And please join us again in October. I can't believe we're almost at the end of the year. Imti, if that's all from you, guys, that's all from me. And appreciate your time. And you must all have a great day. Thank you very much.
Thanks, Verlyn. Thanks, everyone.